In the fast-paced world of trading, managing risk is just as critical as identifying promising opportunities. Many traders fall into the trap of allocating a fixed number of shares or contracts for every trade. Yet this approach ignores the unique risk profile associated with each asset. Advanced position sizing, specifically through volatility-based analysis using average true range, ATR, empowers traders to calibrate their positions to market conditions dynamically. Imagine you are a trader named Anthony. Over time, Anthony realized that treating every trade the same was not only simplistic but dangerous. For instance, buying 100 shares of a low-volatility utility stock is not the same as buying 100 shares of a fast-moving biotech startup. Anthony learned that volatility must inform his position size. He discovered ATR, a technical indicator that measures market volatility by decomposing the entire range of an asset price for a set period, typically 14 days. ATR does not indicate price direction, but it does reveal how much the price moves, on average, during each period. Here's how Anthony uses ATR for advanced position sizing. Step 1. Determine dollar risk per trade. Anthony decides he will not risk more than $500 per trade. This is his maximum tolerated loss should the trade go wrong. Step 2. Identify entry, stop loss, and ATR value. Before entering, Anthony identifies his entry point and sets a stop loss. He notices stock X is trading at $50, ATR is $1.50, and he decides to place his stop loss to ATR below his entry. $50, 2x $1.50, equals $47. Thus, his per share risk is $3. Step 3. Calculate position size. He divides his dollar risk by the risk per share. Position size equals $500/$3 is almost equal to 166 shares. Instead of round lot trading, his share count is now tailored to the asset's volatility. Step 4. Adjust for high volatility or low account balance. If the ATR is higher, his stop loss is wider, which in turn reduces his position size. Conversely, a low ATR allows for larger positions within the same dollar risk. This keeps his exposure consistent, regardless of how volatile the market becomes. Step 5. Portfolio application. Anthony realizes he can apply this methodology to his whole portfolio, not just single positions. By adjusting each trade for volatility, his aggregate portfolio risk remains balanced. There are several benefits. It avoids over-leveraging in volatile markets. It helps Anthony stay disciplined, no adrenaline-fueled doubling down after losses. It acknowledges that not all trades are equal. However, Anthony remains aware of nuances. Thinly traded stocks may have sporadic ATR readings. ATR may expand dramatically during panic events, requiring discretion. He remembers that position sizing is not about maximizing wins, but about surviving inevitable losing streaks. By aligning trade size to real market movement, Anthony removes emotion and guesswork, implementing a professional-grade risk management method that empowers him for long-term success. This is how volatility-based position sizing using ATR translates theoretical risk control into decisive, practical action for the trader who seeks consistency above all.